Are you waiting for the next market crash? Are you in a bubble? You are probably watching this video right now because you are worried whether this is still a good time to start investing. In this video, I'm going to teach you the best investment strategy to apply in the market right now. I'm actually going to teach you this strategy by telling a story of three friends: Tiffany, Britney, and Sarah, with each another perspective on investing. But let me first tell you what they have in common. Each month, they save $200 of their income and invested in the S&P 500 over the last 40 years, from 1981 to 2020, which totaled to a whopping $96,000. But after 40 years, they all ended up with different returns based on their investment strategies. And I'm going to be honest, I was shocked myself when I calculated the results. So stay tuned to the end of the video. Tiffany, Britney and Sarah all knew the value of buying stocks and holding them for the long term. And all they did was invest in the same thing, an S&P 500 index fund. Once they bought, they never sold and always reinvested their dividends. But what made them different was their strategy on timing the market. They waited for different market signals to start investing. Tiffany and Britney, for example, were the ones you could probably best relate with. They are aware that the stock market could be very volatile, and they wanted to avoid market crashes as much as possible. During my sample, there were 5 major market crashes. We will cover Black Monday, the Gulf War, the dot-com crash, the financial crisis, and the most recent one, the COVID crash. In the table on screen, you can see when they occurred, their duration, and how deep the market dove. So let's start with Tiffany. And let me say this first. You don't want to be like Tiffany. She is literally the worst market timer ever. Tiffany was waiting for the market to drop before investing and was patient for 6.5 years, saving steadily. She was so tired of waiting that she just decided to put everything she had saved already into the stock market. But it turned out that the day she started to invest was at the absolute peak of the market in 1987, right before Black Monday, and resulted in a 33% crash the following days. Luckily, Tiffany had a strong stomach and she never sold, but she lost her confidence for a while. And instead of investing, she focused on saving her cash again, only to make the same mistake at the next 5 market peaks. Each time she invested the full amount of her saved cash, she had to watch the market crash immediately after. To make it even more fitting to her own lives, I also included the 2020 COVID crash. This crash made the stock market plummet by more than 34%, and she has been saving cash ever since, waiting for the next market peak. For this strategy, I am making the assumption of a 3% interest rate, so it reflects the average savings rate over the last 40 years. Despite the fact that she was so terrible at timing the market, Tiffany's investment still weren't performing that bad. The $96,000 she saved and invested over the last 40 years is now worth $748,000. Even though she invested only at the peak of the market, she still made a nice return thanks to the power of compounding interest. Since she never sold, her investment always recovered and flourished as the market inevitably recovered to reach new all-time highs. Even now, as we speak, the S&P 500 has been fully recovered from the COVID crash and made new all-time highs again. Britney, in stark contrast to Tiffany, was a real visionary. She also saved her money in a savings account earning 3% interest. But she correctly predicted the exact bottom of each of the 5 crashes and invested all of her savings on those days. Once invested, she also held onto her position in the S&P 500 while saving up for the next market crash. And I cannot express enough how hard it is to predict the bottom of the market, which also shows this would be the absolute best scenario when we are talking about market timing. In 1990, with the Gulf War breaking out in the Middle East, Britney again decided to dump all of her cash in the market when it was down by 19.7%. And even in 2007, she was waiting to invest until the market fell all the way down to a 56% drop, again perfectly predicting the exact bottom, and dumped all of her cash just in time for the recovery. And in 2020, Britney wisely waited until March 23rd to dump her savings into the market, buying at a steep 34% discount. For this impossibly perfect market timing, Britney was insanely rewarded. Her $99,000 of savings has grown to $1.1 million today. It's certainly an improvement compared to her friend Tiffany, but it's interesting to note that when comparing the absolute worst market timing and the absolute best, the difference is only a 46% gain. Both Britney and Tiffany maintained a buy and hold strategy and benefited by compounding their gains. So what about Sarah? Sarah was a little different from her friends. She didn't care about timing the market at all. She didn't watch stock prices or listen to all those analysts screaming that the market is going to crash this year. In fact, she only did one thing. On the day she opened her account in 1981, she set up a $200 per month auto investment in the S&P 500 index fund. And she never looked at her account again until now, at the end of 2020. Each month, her account would automatically invest $200 more in her index fund at whatever the price at the time happened to be. She invested at every market peak and every market bottom, from January to December, every single year. But the big contrast with her friends is that her money never sat in a savings account earning only 3% interest. Instead, she put all of her savings every month into the stock market. When Sarah was ready to retire, she was pleasantly surprised with the result of her investment strategy. Her slow and steady approach had grown her investment portfolio to a whopping $1.4 million. Even though she didn't have Britney's perfect ability to know the bottom of the market, Sarah's investment strategy still crushed Britney's by about $450,000. So, what's the moral of this story? If you are a person that is waiting for the next market crash to start investing, please let this video be the proof that you shouldn't worry about timing the market at all. Instead, start investing as of today. In the future, the difference could be even bigger as interest rates are close to zero and the stock market yielding 9% on average. This is a huge opportunity cost. By just investing consistently, you will have the biggest rewards in the future. Remember, time in the market beats timing the market. Please leave a thumbs up if you liked the video and subscribe to my channel so you don't miss any of my weekly uploads. Have a great day and see you in the next one.